Yeah, welcome here today. So appreciate everybody being here. So we're gonna get into what I call kind of trading Nirvana. It's how you can buy options at a discount. So I'm gonna go through 7 option strategies and gonna focus on really two that I really like a lot and that we use a whole lot at Power Cycle Trading. So those are calendar and counter diagonals, but I want to show you 7 different strategies kind of so you can see and kind of see the assortment and kind of we'll back into that counter diagonal and you see how unique it is compared to some of the other income strategies. So that being said, let us get started here. So a little background on myself. I've been actively trading for now over 40 years, which is kind of, kind of pinch myself thinking about it. So I started out my trading career back in the 80s on the oil side, was able to get in with a company called Coastal Corporation. They actually had a training program where they bring you in and they would train you at that time to trade crude oil and different oil products and things like that. So it was a really great opportunity. Sent me down to their refinery they had in Corpus, Texas. Spent about 3 months down there. Really kind of focused on, just understanding how oil, you bring it in, process it through the refinery, comes out into different products. So kind of get your footing and the foundation of it. And then finally ended up in the cargo side of things, first scheduling cargo tankers and scheduling oil, and then ended up in the cargo trading group and spent about 5 years at Coastal. Sent me out to Singapore for about 2 years, traded products out there in Asian crudes. And then about the mid 80s, I went to work for a company called Trans World Oil, got hired out of Houston for that company, ended up spending about 17 years. At that point, they were the largest oil trading company in the world. It was Trans World Oil, Fibro, and Mark Rich. And so we were, into all the different energy sectors. We had a couple different refineries and just supplying oil and trading oil. And then we also got into all the other, commodity futures and foreign exchange. So spent about 17 years there with Trans World Oil, 16 of those years out in Bermuda, which was the corporate headquarters, and ran the international trading desk out of Bermuda for 10 years. Now, that's where I first started trading options back in 1987. And so we started trading our, options on cargoes of crude oil and kind of never looked back. So just, great way to trade. So I really like to look at direction and then kind of tying the option strategy to that directional trade. And those are, kind of the really good trade setups that really provide you with some unmatched kind of winning returns. So that's what we're going to talk about today. So the following presentation today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. So, when we look at option income selling strategies, they basically uniquely enable you to enhance returns by the way of combining long options with short options so that you can generate income on a regular basis. Now, income option strategies are typically short in duration, whereby option premium is sold either on a weekly or monthly basis. And this can really then generate some really great returns on the underlying security, even if it hasn't moved. So it's like, collecting rent on a security. So if you've got rental property, you know what a great, kind of income stream that can be, but we can do the same thing and collect rent on the securities that we own. Now, the first step in this is to understand the secret to income using options, and that's knowing that how to sell time. So that's a really key component for this type of strategies that involve collecting income or rent. Now, when you trade an option or option strategies designed for income, the most important option factor is to understand that concept of time and the impact that it has on the price of the option. So we can basically sell time by actually selling time to take advantage of that option time decay and the time value of the option. Now, the time value of your option is what we refer to as the extrinsic value. So it's the premium that a trader or an investor is going to be willing to pay over the current exercise value, that intrinsic value, based on the option's potential to increase in value before it expires. Now, it's this change in the value of the option based on time decay. This can be measured by the Greek theta. And so time decay is going to actually increase and really starts to accelerate as expiration draws near, and it will actually decrease as your options go more in the money or out of the money because you have less extrinsic value. Now the option theta really starts to accelerate during the last 30, kind of days of expiration. So it really soars. So, looking at this kind of time graph, you can kind of see it, visually here. So let's say you go out, 120 to 90 days out and you buy an option. Now that time decay is going to be very, very small. You hardly notice it. But then once you get about 30 days out, you can see how it starts to drop off. Now, once you get to 30 days out from the option expiration day or day zero, then it really starts to accelerate. Now, the great thing too is we've got all these different weekly options that we can then take advantage of to gain the benefit from the accelerated option theta decay, to put that kind of premium in our pocket. So, this is how that time, either works for you or against you if you're a buyer or seller. So we're going to talk about, how we can take advantage of it with some really unique selling option strategies. Now, the step two is then knowing how option pricing works and how you get the value of your option, how that works. So the basic pricing of the option comes down to three major price components that make up the price. So we've got the time value component times the implied volatility of your underlying option times the security value, your intrinsic value. Now, once we know these variables, then we're going to be able to price out the option and then, kind of know what option strategy we want to use. So here's like a good illustration of how value of your option comes together. So, every Thursday we have a new weekly option series. Now, most all the, primary big option or big securities are going to have weekly options. And a lot of the ETFs will have, not only weekly options, but we have daily options. But, if we're trading like a, Apple or Amazon or whatever, they're going to have weekly options that we can utilize. And so every Thursday we have a new option series that comes out. So on that first day, we've got 100% time value component is in that option. So, then we take the time value times its implied volatility times the value of that security, the intrinsic value, and that gives us the option value or the premium of that option. So in this example, we're going to keep the intrinsic value, just set it at a constant of 1, so we can just see how the flow of time and implied volatility impact the premium of your option. So on day 1, we've got 100% time times the implied volatility. I just plugged in a number of 300, so you can see the value of the option or the option premium would be $300. Now we come back in after the weekend, so even on a Saturday, Sunday, that time decay is ticking off against us. And on Monday we come in, you can see the time value component is cut in half. So it's, half of it is all, used up and decayed. So in this example, if I plug in, say, 800 for the implied volatility, you can see then the value of the option is $400. Now, if the implied volatility had said, let's say, moved down to 200, then you can see the value of the option is only going to be half that time value component times 200. So we've got a value of, $100 on your option premium. So you can see how these fit together and create the value of the option. Now, at the end of the day, when we get to day 0, when it expires, time value goes to 0. That component's gone, and also the implied volatility go to 0. So these are two things that we can take advantage of when we're doing option selling strategies, that sell time and implied volatility. We can take advantage of this kind of decay that we know is going to go to 0 at the end of its expiration cycle. All right, so that's kind of a good example there. Now, step 3 is to understand, trading the probabilities. This is what I call kind of the market maker's secret. And it's what they don't want you to understand or know, because this is kind of really how they, make their money, by making a market and basically selling the option side of, a trade. Now, when we look at option markets, the markets use mathematical market probability statistics then for pricing the movement of an option into its expiration. So by knowing the probability of your underlying security finishing within a certain price range at expiration, this becomes key then to determining what options to either buy or sell, and then what option strategy to use. So this forecast is what we refer to as the implied move of your stock, or the implied expected move of your stock. And basically what it is, it's just a theoretical estimation of one standard deviation move of the underlying security, by its expiration. All right, so that's kind of where we start with any trade. We want to see, okay, what is the normal one standard deviation move? Where could it go up or down? And that's going to give us an idea of, where we can set price targets or defense targets. So for example, if we were selling an out of the money option that was one standard deviation out of the money, you're basically starting out with about an 84% theoretical chance of winning. So the way this is, comes out is that, when we look at an option and we look at the option deltas, that will give us kind of what we say the probability of where price will be. Now, when we look at option delta, a delta of 1 is like equivalent to 100 shares. All right, so if you have 100 shares and let's say you had you looked at a delta of 16, we'll say right here, this 520 strike has a delta of 16. So if you took the 16 and you've got, a delta of 1, which is equivalent to 100 shares, so that's going to give you 16, from 100 is 84. So then what you were looking at here is that you've got an 84% probability or chance that price will be below 520 at expiration. So here's like a normal distribution bell curve. And if you have the at the money price, let's say at $500, and you were looking at the one standard deviation outside point, that's roughly about a 16 delta. So I look at the deltas like a 16 or 20, and that's going to be that outside point, the 520, or the other side would be 480 to the downside. So that range between 480 and 520 is kind of the one standard deviation range. So basically, if you sold the 520 short, that strike right there, you've got about an 84% chance price will be below 520 at expiration. And if you sold, let's say, a 480 put short, you've got the other, you've got that 84% probability that it'll be below. So there's the way you can look at it. And so again, when I look at standard deviation, like if we look at one standard deviation, let's say the price is trading at $100, and you've got one standard deviation here would be 150, and let's say down here, the one standard deviation would be, like $50 or something like that. So that would be kind of what I call the normal move. So it could go up to 150 or down to 50. That would be a normal move. Now, if it starts to exceed that kind of one standard deviation, this point here, then that gets to be extreme, right? There's less and less probability or less chance that price will get this far out or this far down, all right? So the chance or the probabilities of those price points being hit start to really decline. And that's where we want to look at the probabilities when we're looking at option strategies. And so then we can kind of get an idea of where the best point would be to sell for, hedging or, for, say, premium, to bring in premium. So this gives us a really good way to measure probabilities on a really fast way just by looking at option delta. So here's another good example of delta and how you can use it for probability. So here's just, example on Apple, and Apple here is trading at $190. Now in this example, you've got this 5 July series. It's got 28 days to expiration. So the option pricing model, what it does, it looks at the money price, in this example, $190, the days to expiration, and then the volatility, implied volatility. And then that is what calculates your option premium. All right, so in this example, if you look at the option delta, this will tell you, kind of theoretically, what is the probability of a price being hit and being at that price at expiration. So if you look at the money price, so here's 190, you can see it has an option delta of about 0.52. So let's call that 50, a delta of 50. So it's like flipping a coin. So basically, over the next 28 days, there's the probability of it being at 190 or below is 50% chance, or 190 or above is 50%, so 50-50. Now, as you go further out, the strikes further out of the money, you can see then the probabilities of hitting that price point at expiration is going to be less and less. So if you take that 215 strike, you can see that delta here, it gives you a 0.05, so that's a 5 delta, basically. And so then you can see this is probability out of the money. It says 95.61. So basically then tying that back into your option delta, say the equivalent when one is 100 like shares of stock, and you had an option delta of 5, then you can see your probability of 95% probability that price will be below 215 at expiration. That's the probability. Or the other way you can look at it is that you've only got about a 5% chance that the price will be at 215 at expiration. So this is how you can quickly measure, probabilities of prices being hit, by their expiration time frame or series. All right, so this is a really quick way that we can do that. So, here's just one more thing. Here's like one standard deviation price point would be right about here, about this 15 delta, right there, 205. So if we put that to like a bell curve, this is kind of basically what we're looking at. Okay, so if we take Apple and it's trading here 190, and we get the expected implied move that's given to you right here on Thinkorswim is $12 up or down. That's basically going to be like your 16 delta here. That'd be like a plus 16 delta point here, or the minus 16 delta here. Okay, so that'd be one standard deviation. And so in this example, that's going to be around close to $205. Okay, so anyway, that's how we can then kind of get a quick idea. There's a good probability to price to get there. Let's say in this example to 160 or below. Now, if we're thinking it can get further out, that probabilities go less and less and higher, less probability, put it that way, of those prices being hit within that option time frame, in this example of 28 days. So these are some really key things that you need to, take into any trade that you do before you even put it on. So then, by using this probability analysis, this really, provides, a trader a very useful trading tool for then determining, price targets to trade against. And, it's pretty much all the different option platforms. So it's based on this math of probability. You can see that approximately 70% of options bought are going to expire worthless. And based on this, it's a really good idea then for traders or investors to consider, selling options just as well as your, buying options. All right. So by adding some kind of option income selling strategies to your trading portfolio, it's going to really help you to make a, big, dramatic, positive difference in your trading performance, when you use these kind of strategies correctly. And if you think about it, trading is just a business of probabilities. And to be then successful, it really comes down to controlling your risk and incorporating these kind of high winning probability option strategies into your trading. So that's really what's going to help you to kind of win the race in the long run. Now, step 4 then is selecting the right option income strategy. So in my opinion, one major goal for every trader is to select trades based on what's going to give you the most consistent positive returns with low defined risk and not always the greatest return. And one of the best ways to achieve this then is to know the different various option income strategies that are available, how they work, and then, select the one that's going to be best suited for your trading style, the market environment you're trading in, and your kind of risk profile that you have. As far as, what's, a fair amount of risk for you. So what we're going to look at is, kind of some of the top kind of income strategies. So these are going to be boiled down to, when we look at some of the top ones, it's going to be the covered call. It's going to be what we call the protective collar, which is a great way to hedge what is the covered call. And then we've got the vertical credit spreads, the iron condor spread, butterfly, and then what I really want to focus on are these two strategies here, the income calendar and the calendar diagonal. Okay, so these are some really great, unique strategies, but and they're all ones that are really kind of can help any portfolio. But the ones that I really like to focus on, and we use a lot at Power Cycle Trading, are these two strategies here, especially the calendar diagonal. All right, so let's go through the strategies and kind of. You can see then, the dynamics of them and then how they work and how they might be of use for your trading. All right, so the first one we're going to cover is the covered call. Now, the covered call is kind of a, the longer term growth and kind of income strategy that can be used by, investors or even institutions for their clients. So it's really the basic or the most basic income strategy. Yet it's really, highly effective for bringing in weekly and monthly option income to your trading portfolio. Collecting that rent on a security that you might own. So let's go through an example here. So one second here. So let's say, Joe owns 500 shares of the XYZ company, and he bought these shares for 40 bucks per share. Okay. So, he's tired of just getting a 2.5% annual dividend. And he wants to, look at earning income from those stocks that he owns. So what he's going to do is he's going to sell calls against the stock that he owns. So here's what he does. So it's like collecting rent, right? So let's say on the 16th of December, Joe goes out, he sells 5 of the 24 January weekly call options with a strike price of 42.50. And for doing that, he brings in $1 per contract that he sells. So Joe's getting $500, which goes right into his brokerage account for selling that, that $42.50 strike. So this is kind of like a 2.5% return in a little over 6 weeks if he keeps that 500 bucks. So he really likes this outcome of selling these options. So it's a lot better than just getting that 2.5% annual dividend. So he gets that plus he's going to potentially make 2.5% return in addition to the dividend he's getting in that 6-week period. So it's a great way for him to bring in more income. So basically, here's what it means. Joe then is given the right to the buyer of those call options, the right to buy that stock on the Friday, the 24th of January or before at 42.50. All right, so he sold it and he's obliged to, if that buyer comes in and wants to exercise it, that buyer is going to be able to get it at 42.50. Now, so here's what happens then at expiration. Now, let's say the stock, it just goes to 42. So it didn't get to 42.5 at expiration, but it did get to 42. Now, what happens is the options are then going to expire without being exercised, since the value of the XYZ company is then less than the strike price of 42.50. So Joe just made $500 from selling those call options. So he's very excited about that additional income he's bringing in on those shares. All right, so here's what would have happened though, when it went to 43. Now, if it went to 43, here are a couple of things. Joe, he could buy back the options right back on the day of the expiration or before. And let's say that, we had that time decay kick in. So probably the price of that option would have been less than what he sold it for. So he sold it for $1. And if it had that time decay, which it will, he may have been able to buy it back for just 50 cents in this example. So if he bought it back for 50 cents, then he made 50 bucks on that position, right? So he had $1 price that he sold it for, less the 50 that he bought it back. So he made, 50 cents or $50 on that sale of those options. So this still would be, like about a 1.25% over that 6-week period, or about 10.8% annually. So again, this really beats just getting that dividend rate of 2.5%. Now, so he's going to get that plus the additional income and that return he brings in from selling those options. So it's a really great way to get that additional income or rent on those securities. So as long as Joe owns those shares, he can then sell options for the next week or next month and repeat this strategy over and over. So the main concept then is really collecting income or rent weekly or monthly on your long, option shares. So that's kind of how that covered collar. All right. So this is another kind of variation of the covered call, but adding some protection to it to hedge it. So, building on that covered call example, here's, basically how it works. Now, if your covered call, drops in value and then you own put to protect against the gains of any downside move, this is what we call the protective collar, okay? So basically what you're doing is you're combining two different, option strategies together, and this is the protective put and the covered call. So when you have a protective put, or sometimes referred to as the married put, basically what it is you're going to be long a put option, and then you're going to be long the stock, as well with that. Now, when we look at a protective collar strategy, what you're basically having is you've got that covered call, okay? So you're having a covered call, which is you're long a stock, but then you're short a call against it. You're collecting rent on it, right? Now, to protect your downside, we can then add a put protection to it, and that's going to be the protective put or the married put. So in this situation, then you're long the put option and you're long that stock as well. All right, so visually, if you look at it, so let's say you're long a stock here at $100, okay, and then you sold a call option above it, say at 150, right? So you've got that 50, you've got this, you're getting premium for selling that out of the money call against it. Now, you're bringing a premium there. But if the market goes down, the way you can do it is you can protect your downside by buying a put, okay? Buying a put below it, all right? Buying a put. So that's your protective collar. So you're short a call above, and then you're long a put below to protect yourself on any downside move. All right, so a lot of times you can finance the purchase of the put by the premium you're bringing in on the call, so you can reduce the whole cost of the structure. So basically, you're combining the two option strategies together, and now you've got that protective collar. So it's a really great way to incorporate that into your, option selling strategy. So here's, basically what you've got. So if the stock then you own was to go down in value, the call option that you sold against it would go down, allowing you to buy back that call at a cheaper price, giving you a profit on the call option. So most likely the call option though would, probably expire worthless or unexercised, so you get to keep that full premium. So remember, you sold the call option short at a higher price, in this example that we're going to go through. Now, the value of your put option that you own, if you, bought a put against it, would actually go up. So remember, if you are, when you're using options, if you want to take advantage of a downside move, you can buy puts, and that's going to profit if the market goes down, or you can sell calls, and if the market goes down, you're going to be able to buy that short call back for a profit, all right? So that's how this works in your favor. So the put, you're long a put, so if the market goes down, that's going to go up in value. If the market goes down, the short call that you sold is going to, go down in value and buy that back at a profit. Now the underlying stock goes down in value, all right? So you're offsetting that stock going down, the value of it going down, by the put that you own and the call that you sold. So you're offsetting that downside move of the stock. So that's that protective collar. So let's go through the details here of what Joe does to set this protective collar up. So remember, he owns 500 shares of XYZ, and he bought those shares at 40 bucks. Now, on the 20th of December, now the stock is trading at $45. So Joe, he's got a nice profit locked in. If he can lock it in, he's got 45 bucks, and he thought, and the shares costing 40, so he's got a nice profit. So he wants to hedge that position. Now the overall markets, there's a lot of uncertainty coming in and volatility. So he wants to lock that 45 in and protect it, that position. So what he does, he goes out and he buys, he owns 500 shares. So what he does, he buys 5 contracts of the 24 January weekly puts, all right, on XYZ. And again, remember, one option contract's equivalent to 100 shares. Now he does that, he buys these puts with a strike price of $39, and he pays 90 cents per option contract for 5 contracts to protect that $500 share, 500 shares, if the stock goes down. But at the same time, he also sells 5 contracts of the 24 January weekly call options with a strike price of $49, and he brings in $1.10 per option contract on that. So here's what he has done. So we're going to look at the break even and his potential profit on this cost of the collar. So here's his cost of the implementing that collar again. So again, he owns the 500 shares of XYZ that he bought at 40 bucks. And then he bought puts. He bought the 39 strike price put, and he had to pay 90 cents per contract. But at the same time, he sold the 49 call above it, and he brought in $1.10. All right, so he's owning those $40 the shares at 40 bucks here, and then he above it, he's selling up here a call to protect, to bring in premium. He's selling the call at a $49 strike here. All right. And then he's going to buy a put below it for protection. He's buying that 39 put down here. All right, so there's his protective collar. He's collaring the shares that he owns at 40 bucks. All right, so here's what the cost is. If you look at it, he paid 90 cents, so that's a debit cost there. That's going out of his pocket. But he financed it basically by selling the 49 calls, brought in $1.10. So net, he's got actually a credit from doing this protective collar of 20 cents per share. All right, so then you can see the break even here is $40, the cost of the shares, less the 20 cents. So now he's reduced his break even down to $39.80 per share. Now his max profit then it is at $49 or above. He's capped that, but that's his max profits capped there. But he brought in $1.10. Okay, so here he's got your 5 contracts, to protect that 500 shares, times 100 to make it into an option contract equivalent. And then you look at your collar cost, you've got the 49 plus your 20 cents that you get from that, the net collar was a 20 cent net that you had in, and then your shares $40. So you put that together, then you've got the potential is to make $4,600 on those 500 shares. That'd be a 23% return. So you're capping your profit here, but your profit potential is 4,600, which would be a 23% return on your capital at risk. And then your downside loss is you're capping that loss at that 39. That's your point here that you're going to protect the downside to. So then if you take those 5 contracts, again, times 100, then you've got your share price 40 less your 39, which is what you're capping, your put 39 bucks there. You have a 20 cent basically credit. So you see 39 plus 20. So your downside is capped at a $400 loss, or you lose 2% of your return on your capital that you have, put out. All right, so that's how you can really protect, your downside, to limit it to 2% in this situation, and you still have potential to make a 23% return, but you're capping that risk to the downside. So it's a really great way to structure different trades to give yourself downside protection, so you're not going to lose, if it keeps moving lower and lower. And that's one thing that's with a covered call. The big problem with a covered call is that you're owning the shares, and if the market collapses on you, it's hard. You're underwater, and you can't then sell calls against it. So let's say these shares at 40 bucks. Let's say Joe didn't do anything, and the market now all of a sudden collapsed, and now it's trading out at $30. Well, you're not going to be able to really sell those calls based on that $40 price, right? You're underwater. So that's the problem with covered calls, is that if they do sink below your cost of your shares, then it's hard to bring in that income. All you're doing is then speculating and trying to sell calls, and then it could go up against you. You get exercise, so it's a problem. All right, so that's the big one big problem with covered calls. So it's really good to actually then do protective put to protect yourself if it does go down. All right, now the next one that we'll look at is really popular, and this is called the vertical credit spread. One second, there are a couple of different questions here I want to check out. Well, when you do the protective put, you're doing it in you want to do it in your same option series. So let's say Joe, in this case, he's going out about 6 weeks out. Okay, so it can vary. What you really want to do is look at your charts and then see how far out you need for protection. So let's just, for example, let's just, let's just take a current example here. If let's say you are, I don't know, let me just pull up something. And I'll just pull up Apple. Let's just do a what if. Let me get. So let's say you own a bunch of Apple shares, and you want to keep the shares, you're just collecting rent on it, but you want to protect your downside. So, what I do is I want to look at the charts to see, let me change this to a candle chart. So I want to see where I want protection, okay? And then I want to see, so let's say, for example, Apple, we'll put this on a weekly, see long-term. So if you are, if you've got Apple shares, let's say you want to, really good protection, and you can see, let's say, for example, you want to protect it if it breaks this low here. You don't, you want to protect your downside. So that's going to be where you want to start capping your downside risk. So let's say 219, let's say 220 or something like that. So right here, what I would do, typically you go 30 days out. You could just easily go 30 days out, or you can go a week or 2 weeks. So if you really wanted to, it depends on your time horizon. So, if you're trading Apple, I mean, you could literally sell options weekly, right? You could sell weekly options. So you might have a weekly options with a protective put and do that weekly, or you might decide, okay, let's just do the monthly option. So you go 30 days out, something like that. So that's typical what you could do. Or you could go, further out if you don't want to have to manage it, too much. You could just do a little bit longer time frame. So just that's kind of what you kind of just plan your duration based on, what's going to work for you as far as managing. But typically, monthly options might be an easier way to go than versus, if you're more passive than being real aggressive. So if you're more passive and you've got this in an account, you might just, be using monthly options 30 days out. So that would be kind of what I would look at. Yeah, so the $49 is your call that where you're protecting not protecting, that's where you're bringing in your premium. All right, so let me just kind of diagram this. So so you can kind of, to me, you can visually learn a little bit easier. You visualize it. So you're owning those shares at 40 bucks. Okay, so let's say right here. So you own those shares at $40. Now you're collecting rent, right? And you're doing that by selling that out of the money call. So you sold that call up here. You sold a call option here at the $49 strike, all right? So you're long the $40 here, your shares, okay? You're long 500 shares here at $40. And then you sold 5 contracts here of the $49 strike, and you brought in $1.10 or $110, all right? Times 5. So you bring in that premium there, right? Now you want to protect your downside though. So you bought the 39 put right down here, okay? Just, a dollar below really. So you want to protect yourself at 39, all right? And for doing that, you had to pay 90 cents or $90 to buy that put, okay? The put option, all right? But with the covered call, protective collar, basically, you can see in this situation, you're financing buying those $90 puts by selling that premium. So there's your collar, see? So now your upside is capped here. You still have a potential profit though of 23% return, but it's capped. So you're not gonna, if it starts breaking 49, it keeps going up, you're capped right here at 23% return, but that's still, you're happy with that. But if you don't want to get called out, you just buy those 49 calls back and don't let them get exercised. You might have to put money out of pocket, which then increases your cost of those $40 shares, or they could be the time decay enough where that doesn't happen. But you're capped there, and then you're capped here on that downside risk because now you own the 39 puts. So you're buying that protection. That's your insurance. All right. Does that help kind of visualize that? So it's a really good thing. So if you're doing if you've got a portfolio of shares that you want to collect rent on, it's a wise decision to add that protective put to make a collar. Now, the other strategy that is real popular is vertical credit spreads. And when we look at the vertical credit spreads, there are three types that you can do. There's what we call the bear call credit spread, the bull put credit spread, and then we've got the long iron condor, which is kind of the combination of the two together. Now, what the bear call credit spread is, it's going to be one that you're going to use if you think the market's going to probably go down. But it's great because you can still make money over time, even if the stock doesn't go down. If it just goes stagnant and goes sideways, you're still making money. You're collecting that rent, you're getting that income, and the time decay component is working in your favor. So basically what you're doing is you're selling one call while at the same time you're buying a call with a strike higher in the same option series. So you're not naked short that call. All right. So if you're naked short a call, and it goes up, you've got unlimited, loss. But if you buy a call above it, you're capping that risk. Okay, you're capping it. So that's the credit spread, where you're going to just get your premium that you sold and brought in as your profit, but you're capping in the upside possible, risk. All right, and these have what we call a negative risk ratio. So in this example here, this would be like selling a 20 delta short strike right here. So here's the strike here, 1020. All right, so let's say you sold that 1020 strike here. So you sold a call at that 1020 strike. And then to protect it, you don't want to be naked short, because if it keeps going up, you're unlimited risk on the upside if it does that. So to do that, to cap it, you buy a call above it. So in this example, you're short the 1020 call, and then you bought above it, $10 above it, the 1030. So now you've got a $10 wide spread, which one option contract, that's equivalent, that'd be like $1,000 spread width. And you sold that 1020 short here. For doing that, you brought in a credit or a premium of $200. You received $200 credit, all right? So that's gonna be your profit. If it closes below 1020 at expiration, you keep that. But here's the deal. So you've sold, this is a $10 wide spread. You brought in a credit of $200, your premium. That's your potential profit. But your risk is the difference, at $10 less the 200. So you've got a potential of $800 of risk. So it's what we call a negative risk ratio. You're risking $800 to make $2, or you're risking $4 to make $1. Now, this would be a 25% return if you have that price closes below 1020, you keep the 200 on your risk of 800, you've got a 25% return. Now, these are what we call probability trades, because based on the option delta, theoretically going into this trade, you've got an 80% probability that price will be below that 1020 at expiration based on the probabilities, and these are theoretical. So that's why your return is, so low, because you've got theoretically a high probability that price will be below 1020. All right, but that's how those work. All right, so those are the credit spreads based on that probability assumption that price theoretically will be below your short strike 1020 based on the option delta probabilities. Okay. So that's a vertical call credit spread. So here's an example of one that we had set up on Tesla. And this was basically what we call a cycle high reversal. So we had Tesla here, and it was coming in, had a great move up. And then we get a cycle reversal right here, down here. Now in the course, this is the tool that we're going to use. So you'll get this indicator, the cycle reversal indicator. Okay, so that's part of the package for course package 1 and 2. You'll get this tool, and we're going to use that in the course for showing you how to time these calendars and things that we're going to look at. But in this example, this was selling a credit spread when it started to reverse to the downside. All right, so this was like on the 18th of September, and then you know, it was sold here, and then took profit down here. It collapsed, and you know, was able to just let the thing expire worthless. All right, so here was the credit spread set up, what it looked like going into this trade. So basically, what you're doing here was selling an out of the money bear call credit spread based on that. This was actually a 23 delta short strike. So what you had is you sold the 282 and a half, bought the 285 bear call credit spread. So you're short here. You can see you're short the call here, and then above it, the cap potential risk if it keeps going. If it was to go up, you're buying that call there at the 285 strike right there. Okay, so you've got a $2.50 wide spread that you put on, and you brought in 50 bucks. So $50 in, and your credit spread width is $2.50. So you've got a, you know, if it expires below that, you're going to make a 25% return. So that's how that works. Okay. Now, so this actually then, you know, it was trading right here at expiration or going into expiration. And so it was like, you know, it went to zero. So that premium was at zero, and that's your, kept that 50 bucks that you sold, and that's your profit on that, a 25% return. The moving averages on the chart, okay, sure. These moving averages, I'll show you real quick. So the moving averages I like to always look at and use are the dash kind of magenta purple is the 8 exponential, and then the dashed yellow is the 21 exponential. Okay, so those are exponential, and then the solid red is the 50 simple moving average right there, 50 simple. Okay, so you know, the key moving averages that I always want to know where they are will be the 21 exponential and the 50 are super important. Okay, and then along with the 200, but the 50 and the 21 are the two kind of primary moving averages that I like to use. All right, so that's the bear call credit spread. Now the other one is the bull put credit spread. So this is going to be one if you know, if you think the market's going to, you know, go down, you buy puts. If you think the market's going to go up, what do? You can buy calls, or you could sell puts, right? All right, so this is the bull put credit spread. So this is going to be one that you can use if you think the market's going to probably go up. But again, you can make money over time if it just stays stagnant. So if it doesn't move up and it just kind of churns sideways, you can still make money without it actually having to go up. So basically what you're doing in this one is you're selling a put while at the same time buying another put with a lower strike in the same option series. Okay, so that downside, you're buying a put below it in case it keeps going, in case it goes down. So you're capping your downside risk. And these are also going to be, you know, basically what we call that negative risk ratio type of trade. But it's again, a probability type trade. It's a probability trade. So in this example, this was kind of like Apple to show you. So, you know, Apple this was selling a bull put credit spread, going to be short the 149 put here. All right. So if we sell a put, we're basically wanting the market. It's a strategy for selling a put. You think the market's going to go up. If you buy a put, you're thinking the market's going to go down. All right. So you're selling a put, but you want to cap your downside. So that's the 49 put, 149. But if it keeps going down, with this strategy, you buy the put below it. So this is buying that 144 put down here to cap the downside. So that creates your spread between the 149 and 144. So it's a $5 wide spread. You can see that. Now for doing this, in this example, you're bringing in $105 credit, you know, on the spread. So $5 wide spread. So that's $5 or $500. We're using option contracts, right? And you're bringing in $105 credit. That's going to be your premium received as your profit. And so the difference is your risk. So in this example, your risk is $395, but it's capped. So if you're going down here to 144, you know, your max loss is going to be $395. It could keep going down, but your max loss is capped at $395. So that's also what we call, that's the margin put up. So based on this example, if you bring in 105, your risk is 395. That's a 26% return. All right. So a negative risk ratio. You're risking $3.76 to make a dollar. All right. Again, a probability trade. All right. So this was like a 20 delta or something like that, short strike on the put. All right. So these are, probability trades you can do. And here's an example of one that we had set up on NVIDIA. So this is the other indicator you're going to get with the course, that you'll receive today if you buy the course. This is the other indicator that you're going to get with the course that we'll use in the course. So this is my extreme range band. So here you can see NVIDIA had sold off really hard, and it came down to this blue line, very, very stretched. These are range bands, so what we call extreme range bands. So when it gets to this outer band here, this is what we call 3 ATR, kind of average true range. So it's a very, very stretched outside standard deviation from that 21 EMA here. And so you can see here it gets really stretched, and then we have a cycle reversal. And so when that happened, sold a bull put credit spread out of the money. So it's a really great timing tool for doing these credit spreads, either for a downside move or an upside move. So a great timing tool for selling that bull put credit spread. So here's what we did. Let me get rid of that. Here, okay, 1 second. All right, so we sold the bull put credit spread. So it was trading at 99.66, so it sold the 84.80 bull put credit spread. So the short strike was the 84 put right here. Get my drawing tool here. So sold short the 84 put right there, and then bought below it to cap any potential downside if it kept going down, bought that 80 put here. All right, so we had this $4 wide bull put credit spread, brought in $95.95 credit, and then just went ahead and you bought it back at a penny, so made 94 bucks on the risk of that risk that you had on, and so that was a 30% return over that 11-day period. So these are the kind of the basic returns you get when you do these kind of one standard deviation probability trades. You're going to get either anywhere from 25 to maybe 35% returns. So those are kind of the standard kind of returns you can get. So that was selling like a 20 delta, which gives you a theoretical probability of 80% probability for the trade to be above that 184 by expiration. Now, when you put the two together, this is what we call the iron condor credit spread. So this is a great one because you can leg in or out of it or just do it all at once. So basically it's the combination of the bull put credit spread and your bear call credit spread. So when you fill the stock or whatever, your security is going to trade in a very tight range between two strikes and stagnate, it's a great way to kind of pull that premium out and put it in your pocket. So the long iron condor, is an ideal strategy for this kind of premium collection. But also you're going to cap your risk to the upside or downside by doing it as a spread. And again, this is going to take advantage of time decay and volatility crash. Okay. So the range bands, no, they're not based on the Bollinger Band. No, they're based on range expansion and volatility, but they're not based on the Bollinger Band. So the range bands I've got these for Thinkorswim and TradeStation and TradingView. So TradeStation, Thinkorswim, and so they're available for those. All right. So here's your long iron condor. So basically you can see, just looking at this risk profile, what it is a combination of your bear call credit spread. So you're like short a call, long a call here. You bring in, 50 bucks or something like that premium. And then the other part of the trade is you're short a put, long a put. So you're short a bull put credit spread. And let's say you bring in 50 bucks here. So you've got a total credit of $100 less your spread width. Let's say that's $400, so So you've got your potential risk is 300 to make, this spread here, let's say is $400 wide, all right? So you've got 100 to, premium brought in on your risk now, 300, okay? So that's your iron condor. So it's a combination of two, and you can leg in, leg out, or do it all at once. So it's a really good strategy if you kind of more range bound, okay? Well, these are okay. When you're trading two leg option price volatility hard to close, all right? So what you want to do is just leg out, all right? So the markets, you're going to have to trade sometimes. You're going to have to trade your spread, right? So if you're short a call, long a call, and the market's flying around on you, and you don't know what to do, if you're having a hard time taking it off as a spread, then you just leg out of the spread. So let's say, for example, here's your range. You wanted to close in between here. So let's say the market starts moving up on you right here. So what you can do is you might decide, okay, it's starting to look like it's going to move up. So I'm going to go ahead and close out first. Just close out the short credit spread. So you buy back that call. So you're short a bear call credit spread. You just buy to close the bear call credit spread. Close that out. Leave the bull put credit spread on if you want. If it keeps going up, and then decide to close that out. All right. So you just have to close it out. Maybe one side of the spread, and then the other side you have to leg out. So sometimes you're going to have to do that on spreads. That's just going to be part of trading. Okay. You're just going to have these things happen. So you're going to have to learn how to, if you're, going to do these anytime, but if you're trading, you're going to have to trade, right? So if the market starts to, have some volatility and move and stuff against you, if you're long a call, just a call, you're going to think, okay, maybe I just better sell that call or whatever. So you're going to have to do some trading decisions. So if you're in a spread, sometimes if you're having a hard time getting out of the spread, you can just leg out. That's the other way to do it, okay? So here's an example of one that we did, iron condor credit spread on Tesla, and this was legging the trade. So in this example, Tesla was having a nice move up, and so this trade, what we did was we sold the bull. It looked like it was going to take a nice maybe rip to the upside. So the first thing we did was sell the bull put credit spread first, which was the long part of the strategy. And then as it moved up, added the bear call credit spread to it to complete the trade. But first we did the bull put credit spread, and then it moved up, and then we sold the bear call credit spread against it. All right, so so we'll say this is leg one. This was short the bull put credit spread, and it was trading at 243.30. So sold the 237.5, 235 bull put credit spread. That's a long strategy, wanting the market to go up. And the short strike was 237.5. That was basically a 20 delta, negative 20, minus 20 delta. So 80% probability going into that bull put credit spread. So we're short here, short the put, long the put. All right, brought in 60 bucks credit on that. All right, so potential to make, this was, you can see it was at 14. So that was a $46 profit or 24% return. But that was leg one, was selling the bull put part of the credit spread. And then when it moved up and started to stall, then added the bear call credit spread to it. So then it was trading at 253. So sold the 267.5, 270 bear call credit spread. That short strike was 267.5, right where my pointer is. At that time, when we sold that credit spread, that was a 23 delta on the short strike. So, just look at a probability of 77, brought in 38 bucks there. So the combination of the two together gave us a total of $90 credit, all right? $98 credit right here. And the difference is a $2.5 wide spread. So the potential risk then is 152. So we brought in a credit of 98. The potential risk, if we're wrong, is 152. So this is an iron condor credit spread. All right, so that's what it looks like. We're short that call. long the call, short a bull put credit spread here. If it goes out in this range here, we keep the 98 bucks. Now, if it goes over the long leg, either way, the max risk is 152. Okay, if it goes up, the long leg down or long leg down, you lose 152. So the potential profit is your return on that trade is 64% return. So that's a pretty typical iron condor, what you can expect on that 64% return, something like that. And so it went out, right smack in the middle. So it was perfect, trade setup. So it goes out there. And so kept, look at here, we had that bear call credit, bull put credit spread for 60, bought it back at 4, had the bear call credit spread at 38, bought it back for 3. So had a profit of $91 per spread or a 6% return. So that's your iron condor credit spread, what you typically look at doing those. Now, the next one is a really good one. We do a lot of these. These are butterfly spreads. These are great. So this spread is, really great for kind of a low risk, high reward type setup. And basically, it's a combination of your vertical debit spread and a vertical credit spread. So you're going to have a limited profit, limited risk, but this gives you a really high, reward to risk strategy that you can use. So basically what it is you've got 3 striking prices involved in a butterfly spread, and can be, used, we can do it using calls or puts. So if we think the market's going to go up, we use calls, go down, we use puts. And so again, this is also a spread that's short time and volatility. So you've got that extra, short spread leg to it. So it's a great strategy for bringing in more time premium and implied volatility from doing this. But this gives you is a net debit type trade, all right? So the debit paid is your risk. So here's just what a butterfly typically would look like. So in this example, you're long a call here, short a call, and then short another call, long a call. So you can see your striking points. You've got 2 calls short, 1 call long, 2 calls short, and 1 call long here. So this gives you a really low risk trade with the potential for really high reward. So your max risk on this example was $100. And if it goes out right there at your body of your butterfly, you can make $900 or 900% return. Well, the butterfly trade, okay, the question is, what is the chance of a butterfly success? High, because look, when you do a butterfly or any type of option spread, don't think you're going to get your max target hit, okay? Just be happy if it goes out anywhere in between. So if you did a butterfly and you make it a really wide wing butterfly, you've got a huge profit zone. Now you might not nail it, make it perfect, make the full max profit, but if you go out anywhere in here, you're still making a really nice profit. And the risk reward on these things are anywhere from 2 to 1 to, they can be 15 to 1. So they're really high reward to risk type trades. So they're really high success rate. If your direction's right, these are really high success rate trades. So you'll see our success rate. Well, I'll show you here in a minute. If you do the alert service, we do a lot of butterflies, and we've got a 78% win rate. Okay, 78% win rate. Okay, so that'll be a combination of butterflies, and the other one that we do are what we call the long call condors. Okay, so we've got 78% win rate, so high winning probability trade rates on these. All right, so that's a butterfly. Now, the next 2 are what I'm going to be, teaching actually in depth next Saturday. So these are what I call flexibility trades, and these are really cool trade setups. Okay, and again, at Power Cycle Trading, we do 2 of my favorites are going to be the calendar, which is of all the trades that we do, alerts that are sent out. Those are the most that we typically do, are usually calendar diagonals, because they give you a lot of flexibility, which we'll go through here in a minute. And then the other big trades that we send out that do a lot of are the butterfly and the long condors, okay? But these are fantastic trades that you really should add to your portfolio of trading. And so I'll go through these two with you here in kind of a summary, but then next Saturday we're going to go into great detail on how to use them, when to use them, how they're structured. But the core of the basically what we want is what we call the calendar diagonal, but the core where it starts with is what we call the income calendar spread. All right, so again, it's like a favorite medium to long-term type trade structure that we can use, and kind of non-directional. It's not non. I always have everything I do is directional, but this kind of can be a kind of delta neutral type strategy. So the income calendar spread, what it is, it's a neutral option strategy that profits when your underlying security, your stock remains stagnant or trades within a tight range. So the profit comes from the difference in rate of premium decay and the implied volatility between the near-term short option and the long-term option, okay? So it's possible, so when you have a near-term option premium, if you short the near-term option premium, it's going to decay a lot faster than if you're long further back in time. All right, so let's say, for example, let's say you're short the 7th February, all right, so that's this Friday's expiration, all right? Let's say you're short this series and you're long the series, the 14th series behind it, the 14th Feb. Well, which one's going to decay faster? The one that's closer into time. The 7th Feb series only has 6 days. If you're short that's going to decay a lot faster, right? Than if you're long the 14th Feb that has 13 days. So that's basically what you're taking advantage of, that the decay between the two time frames of the 13 days that you're long versus 6. Okay, so I'll show you an example, but this is kind of the foundation of, then we have the other part of the counter diagonal. All right, so you would use this when you think the stock is going to kind of stay stagnant, and this will produce your income from the time decay between the two duration time frames. So when we do these, we do it as kind of what I call a targeted range-bound trade type strategy. So it's really great for a market condition when you think you want to keep long your longer-term position long for a stock or an ETF. If you're expecting it to at some point break out either to the upside or downside, you want to stay long. But in the shorter term, you think it could turn sideways. So you want to collect some premium on that while you wait. So it allows you to get positioned to get paid while you're waiting for that long-term position to break out. All right, so you're selling against it. It's kind of like a covered call, but instead of owning the shares, you're owning the options. So it's a lot cheaper. Now with the calendar, what you're doing on this is called, sometimes referred to as a horizontal spread or the timing spread. So basically here in this example, you would be long. Let's say you go long out here 60 days out, you go long $100 call or something like that. All right, so you're long that call, the $100 strike, okay, but you're short closer in, again, the $100 call here. All right, you're short that. So you're short the same strike but different time duration. Okay, so you can do this with weeklies or monthlies or whatever. And so if the market goes nowhere, let's say the market just stays there, that'd be the perfect situation. Then the call that you're short here, the 100 strike, that premium decay is going to be much faster because it's closer in 30 days versus if you're long that 100 call here, that's going to be very slow decay. So you're just playing the time decay between those two time series. Okay, so these are the calendar or a horizontal trade is what they're called sometimes. So for example, here's what it would look like if you just want to take a quick look at the math. So let's say you went out and you bought the March 38 call and sold the February 38 call. So you're short 38 call, closer in February series, and long further back. All right, these are done for a debit. All right, so the debit paid is what your risk is. So you benefit from the time decay passing, and also from implied volatility crush. Okay, so that's going to also go down a lot faster in that shorter duration series than the one further back. So these again are defined risks. Your debit paid is your total risk, so you know what it is going in. Takes advantage of that accelerated time decay from your options, different time decay, different decaying at different time based on the different time frame. So an option contract with 4 weeks remaining is going to decay a lot faster than the option strike if you're long 7 weeks back, right? So if the gift of time is further out, so you're long here, so it's going to have a less theta decay than the short option here closer in. So that's what you're taking advantage of in just a pure calendar. All right, so let's say then you bought that March 38 call, you paid $400 for it when you did this on, when you set the trade up. And when you set it up, you were able to sell that February 38 call and brought in $100 credit there. So your debit cost is $300. So then if the stock just trades sideways, you're getting that theta decay on the 38 call you sold short, the 100 strike right here, you're brought in 100. So, towards the February expiration, then that February 38 call is going to be lower in value because that time decay is going to be a lot faster than the one you bought further out, right? All right, so for example here, then, let's say then the call that you sold here, that 38 call, you brought in $100 premium. Now that time decay is crept in, and now it's only worth $50. So your long call though, let's say, is still maintain around 400. It's going to change a little bit, but you can see here then your value has gone to 400 less 50. Now that spread value is up to 350. You've made $50. Okay, that's just basically trading that time decay difference between the long dated and the short dated. All right, so that's $50 profit on your risk of 300. That's a 16 or 17% return roughly. Question on the if you sign up today. Okay, so today the question is if you use that promo code CAL15, I can't write, CAL 15 small cap, you get a 15% discount. All right, so when I send this out to next week after today, when I send this course offer out, it'll be 197. Now you'll get everything that I showed you, but the course will be 197. If you do it today, you're going to get it for 167. Now you do not get a member's discount of 60%. Now if you sign up today, all right, part of the benefit of being a member of Power Cycle Trading Club is that on anything on my website, okay, if you buy anything off my website, you'll get a 60% discount, okay? All right, so but what I'm offering today, no, you do not get 60% off of the 167. All right, I wouldn't be able to do anything if I did those kind of discounts, right? All right, so if you want to use the 60% off, here's what you can do. Just go to my website, Power Cycle Trading, and anything on the website, okay, trading software or whatever. Now with this course, we're going to be using the extreme range bands and the cycle reversal. So you're getting those, at no charge for the course, and those are right here. So those are right here. You're going to get this for the course, as a freebie bonus because we're going to use this in the course. But if you wanted to buy it off my website, it's 197. And if you just decided that you want to buy it, you put your members code in here and you'll get this 60% off that. All right, so anything on the website, anything I have, courses or software, if you're a member, then you get that 60% discount. Okay, that's how that works. So thanks for that question. All right, so that's how the calendar works. Now, so the other thing we can take advantage of is what we call the positive volatility skew. Okay, so just a quick view of what that is. All that is basically is that when your front series, here, let's say 1 day to expiration, is higher in implied volatility, here it shows 92, than your options in the further out series. Okay, so you can see here, this is the next series out, 8 days. It has the implied volatility of 87.58. That's what we call positive skew. So with calendars, if we're selling, higher implied volatility, we're getting more premium, right? The higher the implied volatility, the more premium that you'll receive. So that's part of the benefit. And we'll go through this in greater detail in the course, but this is just kind of an overview here today. All right, so the profit potential here in the income calendar is going to be achieved and reached at the maximum profit when you have the underlying security at the strike price of your short dated option at expiration. All right, so here is a summary of what we've done in the past, and I'll show you an example of the calendar and calendar diagonal and take any questions on those. But here's what started doing these back in June 2019, and through yesterday, we've had 323 trades closed out, 233 winners, 19 break even, 71 losers. So 78% win rate. These are unaudited, but this is a summary of the results, okay? So these are a combination of just calendar and calendar diagonal. So we do a lot of these types of trades, okay? These are really great trades. So here's one good example of one that we did. And again, most of them are calendar diagonals, but the calendar is kind of where it all starts. So I kind of wanted to start there to show you how it works. But here's one we did as a calendar. So this was a put calendar. We were looking for the market to go down. And this was on IYR, which is a real estate ETF. So it says new IYR short was trading around 86.33 cycle high, retracement failure at the 618. So buy a calendar. These are super cheap, low risk trades generally. So 65 cents or 65 bucks was the total risk on this, buying the 26 April, selling the 12 April 85 put calendar, okay? And then on the 12th of April, now this thing was trading right here at, we were targeting 85, and now it's trading right there at 85. That was our target. So anyway, we adjusted this, I think, to put calendar diagonal, but here it was as the pure calendar, and then we're going to go into the calendar diagonal. So here was the trade set up right here, targeting down here to 85 based on what the other thing that you're going to get with the course is the Fibonacci price target mapping course, but we targeted, this was our target, basically to that 200-day moving average, which was 85. We hit the 85. That was where our calendar was set up, and that's where we had the calendar body of it set for 85. And so this is one way we can use this as a targeted trade, super low risk. So we had this trade, we were long the 26 April 85 put, short the closer in 12 April 85 put. That trade cost us 65 cents or 65 bucks. So that it was going out, it was right here at 85, right here on the 12th. And so hitting right there at 85. So now the spread had gone from $65 to now it was $1.11, okay? So $46 per spread, 71% return in 2 days, okay? So that's your calendar. All right, so that is a super low risk trade that we can do, and do what I call targeted. We're targeting that example down here to that 85, which was a huge support level at 85 based on the 200-day moving average, price support, etc. All right, so that's the calendar. Now, from the calendar though, now we can flip it into what we call the calendar diagonal. This is one of the best trade setups, and these are, think about this like sometimes you will hear it called the poor man's covered call, but I call it the smart man's covered call. So how does the covered call work? You're long shares, right? You're long 100 shares. Let's say you're long 100 shares of something to make it equivalent to option. All right, so one option contract is equivalent to 100 shares. But covered call, you're long shares, so it's going to cost you, a lot more than if you're just long one option contract. So 100 shares of something may cost you $20,000. If it's $20 a share versus, maybe buying one option contract, which is still equivalent to 100 shares, but that might cost you $200, right? So it's like a covered call, and then you sell a call above it. But instead of owning the shares, we're going to own the options further out in time and sell calls against it, or we can do it with puts. So it's a fraction of the cost of owning the shares. So, the poor man's covered call, I call it smart man's covered call, or we can do it with the covered put. So this is a medium to long-term directional option strategy for speculating on trend and great for hedging. So it's a vertical diagonal debit spread. So what that means is you're going to be long an option leg with the expiration set further out in time, then short an option leg which has its expiration closer in time. But we're going to do just going to think of it as like a call debit spread, but different duration. So we're going to do different strike prices, like a call debit spread, or like a covered call option trade, or covered call. All right. So what you're doing is you're taking advantage of that short-term weakness or strength that you think will eventually in time revert and cycle either back up if you're call base, or back down if put base. So this provides you time to let the direction kick in. So the great time to use this is when you have a market that's moved down, and then you start seeing it starting to bottom. But a lot of times, markets can just kind of churn, and then for, extended period of time, and then, go back up. Or they could be just grinding up here forever. It seems like they just keep going up, and then they finally start to stall, and that could take for quite a bit of time, and then finally turn over. So when it's in this time frame, this period here or here, these are perfect for these calendar diagonals, because you're getting paid while you wait until it finally kicks in, right? And then it kicks in, all right? So it's a perfect strategy. So you're getting paid, and while you're getting paid, that gives you, it's kind of you're amortizing down the cost of your call if you're doing it for a long trade, or the cost of your put if you're doing it for a short trade. You're amortizing down the cost of your underlying options that you buy. So it takes advantage then of that accelerated time decay characteristic of the front short dated option that's going to decay at a much faster rate than the back long dated, right? So plus, if you have any positive implied volatility skew, the difference between your two option series, that's a benefit as well. But you don't have to have that, but that's just an additional benefit. So then you get that additional vertical spread component. That's what really adds in the directional element for great profitability. And again, if you're just churning and you've got so what we do a lot of times, we may, we'll have an option series close in, and we just get, that goes to zero or something. We keep that premium. Then we roll it to the next option series to short against it. And then we, amortize down or long dated. All right, so it's a great way to do this. So here's kind of graphic example. So think of this as, think of your vertical debit spread. So let's say you go out, and let's say you go out and you do you go out and do the, let's say you go out to the 21 February. Let's say you go out kind of 21 February. That's an option series that's 25 days out. It's 25 days to expiration. So let's say you go out there and do a call debit spread right here, like this. So you have it 25 days out, right? So you're long a call, short a call. So the long call and the short call are in the same option series at 21 Feb, 25 days out. All right, so think of that. So here, let's say you're long this $100 call here, and you're short the $150 call here. Now these are in the same series, same duration series, 21 Feb. Right now, the beauty of the calendar diagonal, in this case, the call calendar diagonal, is that we're going to be long this call here out 21 days. We're going to be long that $100 call here, and we're going to be long that call the 21 Feb, all right, 21 Feb. So that's going to be 25 days out. 25 days out, okay? But we're going to be short instead of like call debit spread, where we're short, long and short in the same duration series, 25 and 25. We're going to be short here closer in. So we could sell this call here, the $150 call here, but we're going to sell that with the 7th Feb option series, which is only 6 days. So next Friday's expiration, okay? So think about it. So then we've got, it looks like a call debit spread. We've got that vertical here, that diagonal, but this short strike is only 6 days expiration. The long has 25. So this is going to decay at a much slower rate. This is going to have a very fast accelerated theta decay. And then what we can do, let's say, so we bring in here, let's say we brought in, you know, $100 credit, right? And then let's say we don't get to the 150 strike, we brought in $100 credit. Well, if it doesn't get to the 150 at expiration, what happens? We get to keep the $100, right? So we keep that $100 and we're still out here 25 days. Now, let's say we had bought that February, this 21 Feb $100 call here, and let's say we paid $300 for that debit cost. But now we've kept the 100 from here. So now we've kept that premium of 100, it's like a covered call. We've amortized down, reduced or discounted our price down to 200. We still have that long call. And now what we do is we sell the next series. We sell the 14th Feb. Now we've got that series. So we sell that. Maybe we bring in another $100 there. If it doesn't get there, maybe we keep that $100. And now we've got our call cost of just $100, and then we make it into a debit spread. So it is just a great strategy for, getting paid while you're waiting, either up or down. Here's one we did recently. This was a really good one that we did. This was on CCJ. This was the energy, this was a uranium stock that has had some really big moves. So here's what we did here. It was trading at $53. And then we did an adjustment here. This is the wrong date. We did one adjustment, it was trading at 57, and then it was trading here at 58. So we worked this thing up and we had a great, trade setup. So the original trade was here. It says trading at $53, daily cycle low retracement reversal up to 200, breaking back above the 21. So went out and buy a diagonal. So bought the 7th Feb 53 call and sold against it the 24 Jan 55. So we had that 53-55 counter diagonal, different duration dates between the long and the short. Originally set up $1.95, 195. Then we did an adjustment here. I won't go through all the details. We did an adjustment here and adjusted it into the short. Now we had the 7 Feb 53 call, and now short the 24 Jan. So we rolled it out to the strike price up to the 58 call. So we rolled from the 55 call short strike to 58 because it was going up. And then we did one more adjustment. We rolled the long dated up to the 54 to lock in some profit. But I don't want to get you confused. I just want you to see the end result. And so then on the 24th of January, now it's trading at $58. So the adjusted trade that we did, we were long. Now we were long the December 54 call. So we rolled the adjusted the trade from 53 up to 54 to lock in the call profit, and we were short the 24 Jan 58. Okay, so long the 54 call in that Feb series, the 7th Feb series, and then short against it the 58 call. So kind of like a call debit spread, but we have two different option series. We've got this one out in the 7th Feb series, further out in time, okay, so longer dated, and then we're short against it, the 24 Jan 58 here. Now this trade was up, now the trade was at $282 per spread profit on our cost of the trade, so we were up 151% return at that point on that trade. So let's just go through and I'll show you what that looks like. So yeah, here's the link again, Charlie. Use this link right here and then put in CAL15. And the course next weekend, we're going to be focusing really on the calendar diagonal of the calendar. Okay, so put that in. Now, so here's the trade. We set this up as trading right here. So we did first adjustment and then took it off right there. All right, so it was trading at 53. Then we did the adjustment, one adjustment to make it, better on the trade. This is what you're going to be learning in the course to, reduce our cost of the trade and then give us a potentially bigger profit. And then it was trading at 57, and then on the 24th it was trading at 58. So here's what it looked like. So when we first set the trade up, this was the original trade setup. We had long the 7 Feb 53 call, all right, and then we were short. The original trade setup was short the 24 Jan 55. So that cost us $1.95 or $195. So we had the original spread was $195. And at that point on the 22nd, it was trading at 57, it was trading at 55.06. Now the spread had gone from 195 to 253. All right, so that at that point it was up $58 a spread on the risk of 195. Now what we did next was it was going up, so we rolled the long, the Feb 7 long 53. We put that up to 54, locking in some big profit. So this was the first adjustment. So we pushed it up to 54, and then we sold against it the 58 strike. Okay, so we're widening out the spread and bringing it up, making more profit. And this is what we're going to go over and show you all these details of how to do this in the course. All right, so then on the 22nd, that should be the 22nd, it was trading at 57.45. We did the adjustment, and then here it is on the 24th. It's trading now at $58. And the adjusted trade we had on the 54 Jan 7 or Feb 7 7 Feb 54 long. Okay, and then short against the Jan 24 Jan 58. Okay, so you can see we rolled the spread up, widened it out, and now the spread, we adjust our cost down here to $1.86, and the spread now is at $4.83. So we had a profit now of $297 per spread or 159% return. All right, so this was just a great setup. We were just trading that move here. And you see how this is kind of what you're looking at. This is when we really like to look for this type of setup when you see a move down here and then it starts to bottom out right here. So this one, it could have just kept going sideways a little bit. This worked perfect to the upside, but here's the perfect setup is where you get the big move. You can see it started moving down here and then it starts churning sideways like this, and then finally turns. This is the perfect place where you start doing these counter diagonals for that move back up. So you don't have to be perfect exactly when you get in, and then it starts to kick up. Just think about the covered call, All right, so that's a really good example there. Here's another one that we did. This was on XLE. So we set this one up, another counter diagonal here. This was on the 31st of December, it's trading 85.70. We did an adjustment to enhance it, make it better on the 10th of January, and then we actually were able to turn this into a free trade. So that's what we'll be, covering in the course, how you can look about, just really lowering your risk. Sometimes you're going to have an opportunity to change these into what we call a free trade, where you have no risk at all, and then took profit on the 14th. It was trading out at 90.53. So you can see it just kind of kept churning up. We just rode it to the upside. But the original trade here was we did a call counter diagonal here. You can see the original trade was right here doing the 17 Jan long 86 and short against it the 87.5 at $1.25. We did an adjustment here on the 12th, the 2nd of January here. Adjusted this to adjusted the spread to the 86, 88.5. So we're rolling the spread out. I won't go off the details here. We'll do that in the course. And then on the 10th of January, we had this adjusted into what we call a long call condor, where we were able to put this into a free trade. And then we took profit on the 14th on this trade here. So this was a really cool trade setup. So again, look at the pattern. This is what you take advantage of. In this example, this is XLE, the energy ETF. So you can see it sold off real hard, and then it starts to bottom out. Okay, so this is the perfect setup. So when it starts to bottom out, we don't know exactly when it's going to turn. So if we get in here, we can do this where we're buying further out, long dated, call option, and selling closer in. And if we don't get it right, we then just keep the premium from the short dated option, go to the next series, and roll it to the upside. Now, with this type strategy, you can use leaps. You can go out 1 or 2 years and buy options further way out in time instead of buying the shares and stay and just you can do this over and over and over. We've done this with Microsoft and Amazon, where we've gone out 2 years and bought the calls 2 years out, and then just write premium against it every week or every month, and just working it like a covered call all the way up. So these are really cool trades, okay? But we got into this one right here, and this turned perfectly. Adjust it here, boom, up she goes. So these are designed more the way we're doing these are kind of for swing trades. All right, so here was the XLE trade originally. The original setup, it was right here. We had the long that Jan 1786 call, short the 10 Jan 88.5, $1. All right. Now then it's trading right here. That was on the 31st, and then we adjusted it on the 2nd to a call calendar. We tightened it up, made it a little bit better, enhanced the trade. I'll, in the course teach you how to do that. And then here we are on the 3rd. It's trading at 87.56. So that spread went from 101 to 186. So now we're up $85 a spread, or 84% return. And then we did an adjustment to adjust the trade to capture a little profit. And then on the 16th, you can see here on the 6th, it's trading at now 88.50. All right, so now look where the spread is. So now the spread, we've got the spread, we're long the 86 call and short against it the 88.5. We've got our adjusted price here, $1, and now the spread is 227. So now we've got $126 per spread, or 124% return. All right, so that was adjusting to calendar diagonal, making it a little bit better trade there. And then we were able to, on the 10th, we were able to adjust this to what we call the long call condor. And at that point, we had it where we had zero risk in the trade, because we brought in, amortized down the long dated, sold a credit spread against it, brought in premium, and turned it into a free trade by doing what we call the long call condor. So we're, long that 17 Jan 87 call right here. We ended up, with that, adjusting that price down like a covered call, brought in premium from the short strikes, etc. Sold against it the call here. That's the 90 strike. So we're short that 90 call. And then we made it a free trade. We were able to sell the 91 call right there, buy the 94. With the premium we brought in there, we reduced this to zero risk and actually ended up with a $3 credit. All right, so now we had a $3 credit with a potential max profit, if it was to go out here, of about 300. The max profit would be $303. Now, we didn't make the max profit, but we had zero risk, and the trade setup here was on going out on the 14th. It was trading at 90.53. So this trade was up to $189 per spread. So $189 plus we had that credit of 3. So a total of $192 on zero risk. All right, so really great structure, to kind of adjust into. So, today just kind of wanted to get you kind of better educated on the, trading and the great investing advantages of options, and just give you an overview of some of the basic, income strategies, and then wanted to kind of back into to show you then how the dynamics of, using the calendar and counter diagonal, that are two strategies where you just get paid to wait. So we're going to, like I said earlier, I'm going to be doing a course that starts next Saturday, the 8th, live and recorded course, just, focused in on the income calendar with a really big focus on that counter diagonal. So again, here, use that link I gave you earlier right here, and we'll go through that in detail, take any questions, and then go from there. So this will be starting next Saturday, part 1, 11 to 2 p.m. Eastern. Then we'll follow up Monday from 4 to 5 p.m. Eastern. And then we'll do a Q&A, live and recorded on it the next day on Tuesday, just to go over, any questions or anything there that you might have. So, put in that link there, and then put in, again, CAL15, and you'll get that discount today of 15% off. And here's everything you're going to get. Now, what you will get, and these are things that I give in the course as bonuses, but these are what we're going to be using in the course, to, with the course, we want to be able to look at, I like to look at cycles, okay? So markets, move in cycles up and down. And so these two indicators are going to help us, to spot and identify cycle turning points, okay? So that's why, I added these two indicators to this course, as a bonus, but these are great indicators to help you trade cycles, okay? So they're, available, Thinkorswim, TradeStation, Ninja Trader. So you're going to get those with the course. And then I always use the what I call Fibonacci price target mapping. So you're going to get that as a bonus. So that's what we use as far as trying to set our targets, okay? So that's why I give you this as a bonus. And then you're going to get a 30-day trial membership to the trading club. So you can start this when you want. You can wait till after the club, after the course or whatever. So if you stay on, it's been $97 a month, or you can turn, we've got other different packages, but it's basically $97 a month. And then we'll do the follow-up Q&A, and then another option trading course that more on the Greeks and stuff. You'll get that. So really good value, bonus value here of over $1,100. Course value 16. Now today, when I go out next week, pushing the course out to all my members and clients, it's $197. But today it's $167, 15% off if you use that promo code that I just shared with you. So you'll get that $167. All right. And then if you want the alerts added to it, and this one I've got 5 months. I'm going to give you 5 months to my alert service. And so with this, you'll get everything in package 1, but for the next 5 months, you'll get all 5 of my different alerts that I send out, plus 5 months of my trading club, and everything in course package 1, which was $197. So you'll get all this, for, I think that was $692, and you'll have that discount off that. But when the different alerts could be, butterflies or long condors. We do a lot, like I said, a lot of counter diagonals. It could be a monthly pinning trade. It could be breakout reversal or credit spread, or, last week we did 2 earnings trade setups that were sent out. So those are kind of the 5 different types that are sent out. So with this, you're going to get, course package 2, and you'll get all that. And so today, it's $697 when I go out, but today it's going to be $592. And so if you break that down by a day on a daily basis, that's $394 a day. But if you broke out just the alert service alone, this is what's a great deal. You're paying basically $283 a day. If you take that $592 less the course part of it, you're getting alerts for $2.83 a day over the next 5-month period. All right. So typically, we do 8 or 12 stocks or ETFs per month, and it could be a butterfly or a long condor, or a calendar diagonal. It could be a butterfly pinning trade. It could be a breakout type of debit spread or credit spreads or special earning trades. So you'll get this for the next 5 months with the trading club, which gives you access. The trading club, I do a weekly Q&A every week, so live and recorded. I do a video newsletter every day after the close. You'll get that every day for the next 5 months. And then you get access to my virtual trading room every day for the next 5 months, where you come in, ask questions on any of your trades or see what we're doing in the room as far as new trades coming up. Plus, you'll get a 60% discount on all courses and trading software that I have on the website. So for the next 5 months. So those are kind of the benefits and breakdown there. Now, over the alert service, since inception back in May of 2018 through yesterday, combining all the 5 different alerts that I sent out, we've had 832 trades, 598 winners, 55 break-even, 179 losers, 78% win rate, unaudited, so really high percentage of winners. That's what I really focus on. High win rate plus, low risk, high reward type trade setups. And 1 second here. Yeah, the indicators we have for TradingView. Let's see here. TradingView, make sure. Yeah, TradingView. You can use TradingView for my indicators. If you do my indicator package, I've got that for TradingView. So here, if you, I'll show you here. So if you come here to the course link here, let me pull that up. So if you put in the link, today, if you did the, package 2, let's say it's, with the course discount, it's $592, but you can also add my indicators here, and I do have them for TradingView. I have to double check here. We've got, let's see here. Okay, so TradingView would be included. Let me double check one thing on the indicators. There's the custom. If you do the full custom, if you add the 195, the indicators to it, I just want to double check here. I've got those for. Yeah, I've got those for. TradingView. Yeah, I've got those for TradingView. Let me double check here on the cycle reversal indicators. 1 second. Yeah, I've got the cycle reversal indicators. Is available for TradingView. Thinkorswim, TradeStation, TradingView. Okay. All right. So put that. Again, go to that powercycletrading.com/special. This is the easiest way to do it. Just plug in that link there. You can, copy it or paste it or just, press on it. Just click on it, and that'll pull up that page there. And then just go and select which package you want, and also highlights, everything you're going to get. So if you want it, course package 1 is, all the tools that we're going to use in the course, which are just, add-ons, just bonuses, basically. If you use that link today, you're going to get, and use Cal 15, you're going to get it for 167, basically 94% off. So just go in here, and the indicators, you can see, if you do want to add the indicators, you can do that, and they're available for Thinkorswim, TradeStation, or TradingView. So if you want to add that, just add to the cart there. So then if you do this course package 1 with those indicators added, for example, you can do all that. You Cal 15, put that in. And you get it for 362. If you want course package 2 with my alert service, all 5 for the next 5 months in the trading club for the next 5 months. And plus everything course package 1, just come down here, click on there. It's $697, but put in that promo code and you're going to get today Cal 15, and there you'll get it for $592. And again, you could add the indicators, which are my 5 study set indicators, you know, my momentum indicators, all that good stuff, if you want to add that to it. Okay, so which indicators would you be getting if you did that? I'll show you. So if you did the add-on indicators, basically you're going to get my custom indicators. Okay, so these are going to be 5 study sets. So let's see here. So you'll get these 5 indicators. And these are my volatility squeeze indicator. Let me see here, get a little bit more detail for you. So these are, you'll get my volatility breakout indicator. Okay, so this is included in it. Let me just see here. I'll just pull it up real quick. It's basically five study sets. I call it study sets, but they're basically centered in around momentum. Okay, so let me just show you exactly what you're going to be getting here. So for example, if you do the add-on, you'll get these indicators. Basically, you're going to get 2 momentum indicators. Okay, so it's what I call cycle 1. This lower study here, this is a really fast momentum indicator measurement, and then cycle 2 is another momentum, which is slower. So these are what I use to forecast direction. All right, so cycle 1, cycle 2, you're going to get the cycle reversal indicator here. And there's one other indicator that I don't use anymore, but it's based on momentum as well. Then you'll get my volatility squeeze study set comes with this indicator as well. Right, let me show you what that looks like. The volatility squeeze, let me find a good one here. Let me put up, so I put on a lower time frame or something to show you what the volatility squeeze looks like. So right here, see this really tight squeeze here? It's what I call a compression squeeze right there. And so this is also part of the study set. The code here is coded in. See those dots? That tells you when a volatility squeeze starts and then when it ends. Okay. So volatility compression squeeze. You can see here, we actually look, this is the 1 hour time frame. There's a volatility squeeze right here. So it's basically, there are 5 studies that will come with this, the indicator package if you add that to it. Now, with the course, what you're going to get just bonuses for the course that we're going to use, you're going to get my cycle reversal indicator down here and my extreme range band indicators. All right, so as part of the bonus course, you'll get the extreme range band indicators, these bands here, with this lower study cycle reversal indicator there. And so that's what we'll be using in the course, and those are just add-ons. So you can see here, this is a really great indicator. You can see how expanded and extreme and stretched it got up to that 3 ATR. Then we have that cycle reversal here. So you get these range bands, reversal indicator, and then down she goes. Now, if you add on the other ones, though, it gets better. So here's that same chart, but with the momentum indicators. All right, so here it was, that same chart I just showed you. Okay, right here, let me show you the difference. Yeah, I'll be question, will I be doing any kind of course on the directional indicators? Yeah, I'll be doing a course here in probably the next month on how to use these indicators in more detail. But so here's, here you can see the momentum indicators starting to shift down. All right, so here's see the momentum indicators going down. We had a cycle reversal. And so I've been, I designed these indicators back in 2009, 2010, and this is what I've been using ever since. So here's a good example on Apple. So here's, Apple really grinding up to the upside, right? And then it starts to, okay, so cycle reversal, see the arrow here? See the cycle reversal down here where my pointer is, right there? But then look at momentum starting to go down, starting to kind of, now I'll use other time frames, but this is a daily. So then you see the momentum here on cycle 1 goes negative. See the arrow pop up? Now with the add-ons, you're not going to get the arrows. You're just going to get the momentum indicators. The arrows, with the cycle reversal, you will, but with the custom indicators, this is kind of an add-on, but you'll get the momentum indicators lore studies with it, okay? So then look at everything. So then you see it starts breaking down, right? Cycle 1, now 2, look at 2 starting to go down. And it just starts to that momentum starts to build. So that's that. Now the extreme range band. All right, so those are the add-ons if you want. And I was trying to find that extreme range band. Okay. And then here's just what you're going to get with the course. You'll get the extreme range bands, but you can see the cycle reversal indicator is just a great tool. So here's the same chart. So see how stretched it's getting? And then it finally starts, see, and we'll go through how these are used, and then it starts to really break down here. That's just, an example on Apple, but that's kind of, what you can look for. Now, so any other question? That was a good question. And yeah, here are some of the other alert trades. Here's some that we've done recently. These are the other ones that we've done. Now, again, you can find out if you purchase this. You can just go into your, members tab and see calendar if you purchase it. If not, you haven't. And then again, these indicators and stuff, these are just going to be needed for the course. So that's why I included this. The price target mapping and those 2 indicators are, included as a bonus gift to you, but these are what we're going to use in the course as well. And then here's just a, nice feedback from one of my members, Pam. She said, just sending a quick note of thanks to you. You could maybe pass on to Larry for all the fabulous teaching he's done through the years. I truly enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and other ways to trade than Larry. So appreciate that. And then the course, we're going to start out kind of part 1. We're going to look at the Greeks that are very important for these types of the calendar diagonal, time value, how the pricing of the options, just so you understand probabilities more. How to use that standard deviation price forecasting to send out, forecast or price targets. And then part 2, we'll start with the income calendar first. All right, so that then leads us into then how to construct the calendar diagonal. So, but the income calendar will go over the basics of, the income calendar, the benefits, how that works for us, characteristics, and their what I call the trading edge, which is time and theta, how that works. Risk review, the trade setup, and then part 3 we'll get into the calendar diagonal. So this is the really meat and potatoes. This is a really fantastic spread trade. So the basics of it, how it works, why we're going to use it, the benefits of it in more detail, and then it has what I call kind of 2 really big edges, trading edges. One is based on time, the time theta component. And the other trading edge is based on a directional component of the direction, that diagonal part. And so then we'll go through the trade setups, how that works, when to use the trade, how to set it up, and then how to make adjustments, when and, how to do that, and what to look for, adjusting into kind of a lower risk, maybe sometimes a free trade. Comes to, resources and a good trading library. I always like to add some trade libraries so you can see past trades, how they work. So that's what you're going to get there. And then the enrollment bonuses, again, you're going to get my 2 indicators we're going to use in the course. So these are the cycle reversal. These will be available for Thinkorswim, TradeStation, TradingView. Okay, so with this course, with this indicator, there's an upper and lower study to the indicator. All right, so the upper study is going to give you the actual arrows, if you want to use that, but the actual signals, the lower study, cycle reversal, so you can see, when these things have a cycle reversal up, cycle reversal down. So it's a great timing tool that we use for cycles, and really going to be something that we will incorporate using in the course. And then the other bonus too is the extreme range band. You'll get this as well. All right, so these are the extreme range band, showing you when markets get too stretched either to the upside or downside, and then we add that with the cycle reversal. It's a really good timing tool. You'll get that, and then you're going to get my price target mapping course. So with every trade that I set up, I always look at the price, targets for profit and for potential defense targets, and this is based on what I call price target mapping, which incorporates using Fibonacci, trend lines, moving averages, and price action and option activity. So it's a really good combination of all 5 of those, and so this is just an add-on bonus for everybody. It's a 3-hour plus recorded course on that, but we'll be using this in the course as well to put together our targets for these types of trades. And then you'll get 30-day trial membership to my trading room, our trading club. Yeah, the extreme range band, I don't have that for TradingView, but I have the cycle reversal for TradingView. All right. And I can show you, if we have time in the course, I can show you how you could set it up for the extreme range bands. I can show you basically how that works as well. Just remind me in the course if you sign up. Now, if you do the package 1, you get 30-day trial membership. If you do the with the alerts, you'll get this for the next 5 months. But with the trading club, what you're going to get is your access to my virtual trading room, which is open each day of the week during the trading week, 9:30 to 10:30 Eastern, Monday through Friday. So come in and ask questions on any of your trades, see what we're doing as far as new trade setups we're looking at. Then I do, like I said, a daily video newsletter. So what the markets are doing, what my outlook looks like for the the next day. Trades are archived, so you can go back and look. We do a weekly Q&A live and recorded. Really good additional traders educational vault with additional trading information, and then you'll get a members discount code where you can put in on anything on my website, and you'll get on any other courses and software, you'll get 60% off. All right. I always like this from Jay. He says, reading books is fine, but seeing the actual option trade setups makes a huge difference. So that's what the trading room is such a great venue for coming in and asking questions to see what's going on there. And then we'll do a follow-up Q&A, which will be live and recorded. We'll probably do this Tuesday after the course. So we'll have the part 2 Monday, and then Tuesday we'll come in and we'll do a Q&A on it. So any questions you have there, you can ask, and plus you're going to get the membership to the trading club, so you can come in during the week and ask questions as well. Then you'll get one more course here, basically a bonus, my option trading tutorial. So this is just another option guide course, 60-page guide with videos on the Greeks, how to use delta, gamma, theta, option pricing, standard deviation. So just gonna additional bonus there for your option training for that course. And then here's just some other alert trades I show you back what we've done recently here. This was from one of my members, Waleed, who actually lives in Kuwait. He said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing I'd like people on the webinar to know is when I get a trade from Larry, I do it blindly as time has shown me. He's dead accurate in his recommendations. So great service, Waleed. And then, Dan, very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. Pay for my subscription with the first 4 trades I took with you when I was learning how to trade options. So a lot of the members have been learning to trade options and taking alerts and paying for those trades while they're learning. So that was really nice feedback from Dan. All right, so again, you're going to get, if you do course package 2, you're going to get the alert service for 5 months plus a trading club. You can start and stop when you want. So this will be $697 when I send it out after today, after this weekend. But if you order today, using that code, you get it for $592, which is $394 a day. And if you break down the 5 alerts, I was looking at this, $2.83 a day. So that's a pretty damn good deal. And so 5 different potential alerts are sent out for the next 5 months, plus the trading club. So you're going to get a lot for your money, and should, with all the trades that you'll be receiving, get paid back for that pretty fast. So now here's another thing too. When I send out a trade, I've got a number of members. They just want the trade setups, right? They just want to see what I'm sending out as far as, because the win rate of these trades over the last 10 or so years have been really great. But so they just want the trades, and they just do their own thing. But I will always give a suggested option trade that kind of fits the trade setup, the chart pattern, the environment we're trading. But if you want to do your own trade, what most of the members will do is, if I send out they're all based on direction. So let's say I send out a go long a call condor, a put condor, go long a counter diagonal. Well, some of my members, they'll just go long calls or long puts in the same duration series that I'm setting the trade up. Okay, so a lot of them so bottom line is, a lot of traders, they just do their own thing. But I'll always give you a suggested option trade that I want to use that will give you even lower risk. Okay, so it'll then come with your entry level and what profit targets we're using, and these targets are based on that Fibonacci price target mapping, basically. What option series to use, okay, stop loss levels and guidelines, and I'm constantly updating these things, and I've given you alert information on the trades, what to do, what to be expecting. Then I do a trade setup video review of the trade after it's sent out later that day. You get my video newsletter daily. Then we do a weekly Q&A, live and recorded, so you'll have that access for the next 5 months. And then access to the virtual trading room alone for every day during the week for the next 5 months. And then discounts on any, software or courses here. So that's what you can look forward to getting for each day during the week. And then here's just a review. We've done, again, 300, these are the counter diagonals since started this back in 2019. And then done 323 trades closed out, 233 winners, 19 break even, 71 losers, unaudited. Showed you these earlier. This was CCJ, great trade. All right, so that was one we did just recently. XLE, showed you that. And then we've got the other ones that we do a lot of butterflies and long condors. All right, so since starting these trades back in May of 2019 through yesterday, we've done 203 butterfly condors. These could butterflies or condors. 144 winners, 14 break even, 45 losers, 78% win rate. Now these can be anywhere from 2 to 1 profit to 25 to 1. The butterflies sometimes are huge potential winners. Okay, so that's kind of what you can be looking for. These are unaudited. Here are a couple of ones that we've done recently. This was Apple long call condor trade setup, and this was done back week 21st of November. It was trading at 228.80, and then we took profit the 29th a few days later, 235.74. So this was doing what we call a long call condor, new Apple long, straight at 228.80. Tell you in the alert, holding support, yeah, etc. Daily positive momentum, upside cross, a moving average cross that I look at. Target 1, 232, target 2, 234. Did a condor, says by the 29 November, 230, 32 and a half, 237 and a half, 240. So, this is what we call a long call condor, which looks something like this, right? At around $85. So very cheap trade, very low risk, high potential return. And then you can see here on the 29th, now it's trading at 237.32. That call condor is now at $168 per spread, or 204% return. All right, so that's just sending out that alert to take profit or take some profit if you haven't. So here's the trade setup. Here again, here are my indicators just to show you. These are cycle 1. If you do want to add on the indicators, cycle 2. Get the cycle reversal, you're going to get that as a bonus. Momentum starting to shift up. Got in right there. Got out right there. And this was doing what we call the long call condor. And so this was basically the buying the 230 call, selling the 232.5 call debit spread. And then against that, selling the 237.5, 240 call credit spread. So the risk profile looks like something like that. Total risk on the trade was $82 per spread, right here, 82 cents, 82 bucks. Spread width was $2.5, 250 less your cost. Potential to make 168 if it goes out in here. That's a 204% return. And on this one, we got exactly that. Went out right there. Boom, right in the middle. So the spread was max profit, went from 82 bucks to 249. So this was up $167 or 203% return, on that trade. And then we've got, here's just one more that we did. This was on the Russell 2000, a put condor. So set this one up on the 14th. This was a really fast kind of day trade, almost just overnight. It was trading at 234.80, got out the next day. It was trading at 228.48. I'll just flip through this so you can see. So we went short right here. Our momentum was starting to go down, and we were targeting this area here, this moving average. And so we did this put condor, and just pretty much in and out within one day. So set this up, the risk, $34, right? That's the huge part. So this was a $3 wide spread with the total risk of 34 bucks. And so this blew from 34 to $1.74 within one day. So we're up 140 bucks, 411% return. Oh, hey there. Yeah, let me do that. Thank you very much. This is from one of my members. Thank you so much. Yeah, let me post that. I appreciate that. Yeah, 1 second. This really nice, very nice. Hold on. See if I can get this up. It's from one of my nice members. Just sent me this. Thank you so much. All right, appreciate that. Yeah, you can just buy the indicator package. Question, can someone just buy the indicator package? Yeah, absolutely. Let me show you where you can get that. 1 second. Now, okay, so if you want to buy just the indicators, just, without the course or anything, just come over here to go to powercycletrading.com. Okay, just go to powercycletrading.com and then come over here to trading software, click on that. And then you'll see all my software. I've got my scanner, this volatility breakout scanner. This is what I use a lot to find most of the trades that I send out. They're based on volatility squeeze. So you can buy that if you want. It's available at Thinkorswim, TradeStation, eSignal. That is $397. Now, here's the thing that you would want to do. Make sure that you're a member. And if you buy membership, then you will get access to any of this stuff on my website for a discount of 60% off. So if you want the custom indicators, here's where you can go. So just scroll down here. Here you can see PCT custom directional cycle trading indicators. Okay, I've got these available at Thinkorswim, TradeStation, eSignal, Ninja Trader, TradingView, and wealth charts. Wealth charts is a separate deal, but do have them for wealth charts. So come down here, and you can just kind of see an overview of what we look at, the momentum indicators, the volatility squeeze. It also has another, what I call support resistance package, where I show you prior weekly low, high, low, close. So come down here and go to course details, click on that, and then come down here. You can see, and then you can, it's $597. Also got another price point, $700. This comes with my volatility scanner. So basically that's where you can buy it. Now, if you're a member though, you can get this for 60% off. And when you get the indicators, then you can see just one more snapshot of the indicators. So whatever you want to look at, I mean, we can, again, I've been using these for a long time. So here's the other part of it, what I call the support resistance package. All right, so for example, here, you can see here, this is on a daily time frame. If you look here, you'll see this dashed green line, dash white. So that's the prior week's close, prior week's high, and below is the prior week's low coming in right down. I'll see, it should be in red. So you'll get that, and then you'll get the other thing that comes with. You can see these swing high and low points here. So and then if you put this on below a daily, let's say you put it on a 1 hour, you can see the dash green, that's the prior day's high, prior day's close, prior day's low. And that's the 50 simple moving average, is color coded. So that's part of the support resistance package, what I call that. All right. So if you do want the indicators just separately, just go to the website. And if you're a member though, put in your member promo code, which you'll get, and you'll get 60% off that price. Or buy the course today and add it to your package, which is even a better deal. Okay. So that was one that we did there on the. Now these are really fun. Open range, sometimes. Open range high-low breakouts, sometimes, yeah. So these are really fun. These are what we call, this is the other part of the alert service that you're going to get. This is this is the, I'm just trying to back up, show you the option pinning trades. Backed up too far. So the other selective trades I send out when I see them are what we call the selective monthly butterfly and calendar option pinning trades. Okay. So these are select. I don't send these out all the time. I just send them out when I see the potential opportunity. But here are a few that we've done, and these are potentially huge winners that you can potentially get. All right. So these are a couple that we've done not too far in the past, but here, what I call, these are my lotto ticket type butterfly trade setups. This one was just amazing. I always look at it and I'm like, wow, this thing was unreal. This was on Tesla. And so this is what we call the lotto trade. So when I see these are sent out to the members for the alert service. So this was sent out, you can see this was back in February. It was trading, Tesla was trading 189.35. And then we were targeting 200 for what we call an option pin, and nailed it to the penny. And so this trade was set up for, ended up with what, 1,925% return in 8 days. So you think that's impossible? Well, it's not. Okay, so here's the trade. So it says this was the alert sent out. Said new Tesla long binary monthly butterfly pinning setup. It was traded at 189.35. Trade set for a potential monthly expiration pin at $200 next Friday, the 16th of February. So it says buy one. So buy 1 or 10 or 1,000, whatever you want to do, but buy a contract of this butterfly. So this was the 16th Feb, 197.5, 200, 202 butterfly at around $12. Okay, that will be your risk. No adjustments or stops. These are binary trades, etc. So here it was on the 16th. Tesla binary butterfly pinning trade, trading at $200. Butterfly going out about $215 per spread, a 1,790% return. Start taking profit here. Make sure to close out prior to today's close. Here it was. Wow, almost perfect pin. Tesla trading at $200.07. Butterfly going out up 230 per spread, 1,916% return. All right, so that's what was sent out on that. And here was the setup. Here's where we took it off. We were looking for that pin here to 200 and to the penny. And so here was the trade setup, the profile of what was sent out. So this was going long the 197.5 call, short the 200, long the 202.5. Butterfly $2.50 wide, 12 cents or $12, $250 wide spread, 12 bucks. Potential profit that hits there at the close, $238, 1,983% return. $12 risk, potential to make $238. And here's where it was going out to the penny. Incredible. Now, when we do these trades, you'll scale out because you won't, because it could go back and forth. But this is just to show you that it nailed it to the penny on this one. This was just incredible. So this went again from 12 cents or 12 bucks to that max profit there of 250. So this was up, $238 per spread over 1,983% return. So, but what we'll do is, if you had 4 or 5 whatever contracts, we'll scale out in case it just whips back and forth. But if you just leave a little bit, that's the potential. That's what happened on that specific trade. So that was really cool. Here's another one that was really good. Not as good as Tesla. That'll be probably the all-time best. But here's another good one that we did. This was on GLD, and again, this was a really good trade setup. And these are my alerts are very detailed, so you can kind of follow along. Here's the new GLD long binary call butterfly trade setup. All right. And so it tells you what it's doing. Trade setup to play a potential upside move to 225. Now this one we originally set for 225, then we adjusted it up, setting it for 230. Okay, so again, we were looking for a pin. So this one did this adjustment here. So now we had the butterfly here. We had the 16 August 223, 225, 227 called butterfly. And we adjusted that up to the 227, 230, 233 called butterfly. And we were adjusted into this trade for 29 bucks was our total risk. And then here it was on the 16th. It was trading around 230.50. So we were targeting 230. So it was up, at that point, it was up $200 per spread or 689% return on this one. So this is one that we started at 225, sent out an adjustment, and we adjusted this to targeting 230 right there, and that's where it went out. And so this was up $203 per spread or 700% return. All right, so this is the trade profile, what this looked like. So we had this, the 227F call long, the 230, 233. So this spread width here, $300 with our max risk of $29, 29 cents, 29 bucks. Potential to make 271 or 934% return. And didn't get it perfect, but close enough. And it was still a great trade. So ended up here, this went out pretty good. This went out right there at 230.47. So this was up from $29 to 232. So this was up $203 per spread or 700% return. And here's one we did not too long ago. Now this one, just to show you, I mean, you're not going to get it perfect every time, but it's still a pretty decent little trade. So here's one that we did just recently on Microsoft on the 7th of January. It's trading at 423.50, and we were looking for, you know, a pin doing this one to the downside. So this was actually a put butterfly. So I'll just kind of go through this pretty fast here. So we were looking at this pin potentially down here at this level, at this 212, 213 level. So we did this put butterfly here, very low risk. So we did the 215, 210, not 415, 410, 405 put butterfly, $5 widespread at 35 cents or $35 risk. Okay, so this is a $5 wide put butterfly. So with the potential, if it went out there at that strike there, 410, to be at $465 or 1,328% return. Now this one flipped back and forth, but still captured a decent little profit. You can see it got out early, you know, because it looked like it was going to rip back to the upside, which it did. But still, to show you how great the butterfly is, here it was trading, had a lot of potential profit still left in it, but it was trading right here at 411. So this spread went from, you can see from $35, now it was up to $99. So this was up $64 per spread, right? But on that risk of 35, that's 182% return. So that's how that butterfly can work out there. And that's it, you know. So appreciate everybody being here. Any specific questions, let me know. Again, just go to this link here. Use that that code powercycletrading.com/special, and I'll pull it up one more time, and so you don't miss out on it. And then use that lower call fit CAL 15, and it'll give you the link. So make sure to take advantage of it. I think you'll be glad you did. And I really appreciate everybody being here today.